Hello and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Are you or someone close to you in the process of buying or selling a home in the United States? If so, you want to be aware that our Financial Crimes Enforcement Network, otherwise known as FinCEN, has updated their anti-money laundering regulations for residential real estate transfers. Yay! We're going to highlight them today as we address the three questions buyers and sellers should ask about information collected on real estate transactions. Thank you for taking time to check us out. And if you enjoy this episode of Three Questions, please consider liking this video and subscribing to our podcast and YouTube channels. On today's episode, we'll be revisiting the ever-evolving real estate landscape, specifically focusing on the recently updated anti-money laundering regulations for residential real estate transfers. And that's compliments of our friends at the Financial Crimes Enforcement Network, otherwise referred to as FinCEN. And whether you are a buyer or seller, you won't want to miss today's episode of the Three Questions podcast. Joining us once again is Jennifer Felten. She is the principal of Westlake Village, California-based RELAW APC. And one of the primary goals of RELAW APC is to inform clients of all the options available to them so that they can make an informed decision about how to proceed in their real estate law case. Jennifer, great to see you. Thank you for making a return visit to the podcast here. Great to see you again.
Thanks for having me.
Well, you know, I got to say, we were brainstorming about a possible another episode, and all credit, I have to admit, goes to Jennifer. She says, Wayne, I got the perfect topic. We're going to talk more about FinCEN. I went, oh, how wonderful. It seemed to be, I guess, we on previous podcasts, which you wouldn't probably be aware of, they haven't, some of them haven't been posted yet. Actually, all of them have now. That's not true. With Rhonda Cohn, with Will Flanagan and Scott Fuller, and beforehand yourself, we talked about the new broker compensation agreement. Correct. And I think we've pretty much beaten that topic to death. If you don't know what I'm talking about, we have 4 podcasts where we actually spend time talking about it. So by all means, I recommend you go to the website or go to your Apple or Spotify to get your full on that. But we're going to focus today our attentions on FinCEN and specifically, and I'm going to quote him here, the recently issued, in quotes, a final rule to require certain persons involved in real estate closings and settlements to submit reports and keep records on certain non-finance transfers of residential real property to specified legal entities and trusts on a nationwide basis, end quote. Whoa.
That makes a lot of sense, right?
For you.
Of course. Doesn't everybody know what to do?
I'm not even sure I was enunciating in the right places, but hello.
Yep, this is our government at its finest, right?
So just before you go, for everybody who, we have people listening all over the continent. So FinCEN is in fact a department of the Treasury, right? Is that not correct? They're not their own separate entity. They're actually supervised, I guess now by, Janet, was it Yelton?
Yes,
Treasury Secretary, soon to be another one coming up here in the not too distant future. They're fighting over that position right now in public. So correct. What is the intention of all of this?
Right. So one of the charter of the Department of Treasury includes a provision relative to protecting our financial environment, right? And so looking for bad guys, looking for money laundering, looking for misuse of funds is specifically in the charter and the goal of FinCEN, right? Financial crimes. So this is criminal type of investigations that they're doing, looking for bad guys manipulating finances. And the reality is that real estate is a really good way to launder money if you're trying to launder money. So they're not wrong to be thinking about and looking at real estate as an avenue for financial crimes. The question is, if you know it's happening, how do you find out? How do you investigate it? And what can you do about it? And so this new reporting requirement is designed to try and elicit and find those bad guys in our real estate system.
Well, and I know you're aware of this, FinCEN recently established what is known as the Corporate Transparency Act, or CTA, and that mandates that certain U.S. companies have to disclose information about their beneficial owners, and these are individuals with substantial control over the company, to FinCEN. So the CTA is aimed at combating money laundering as well, terrorist financing, and other illicit activities, much like what you're referring to with the other FinCEN rule that we're dealing with today. Now, I'm going to take a stab here and guess that there's some correlation between these two rulings, that they are somewhat complementary of one another. They weren't done in a vacuum. This wasn't completely coming from left field.
No, I mean, the idea is that bad guys often use entities as a vehicle to move money. So the Corporate Transparency Act requires entities to report the information about their ownership and leadership, looking for those bad guys. It's the same actual data and information they're collecting on real estate, and it's the same issue. The new reporting is only for transactions where an entity is the buyer. So if I'm buying in my own name, this new reporting requirement does not apply to me. But if I'm buying in an entity or in a trust, which many of us do, I now am potentially subject to reporting requirements. The idea being that I might be trying to hide behind the shell of that trust or the shell of that LLC.
Okay, just going back to the CTA for 1 second, we actually did a podcast on that topic with a friend of both of ours, Janice Miller.
Yes.
It was back in January, I believe it was. I'm starting to lose track of time. But again, all episodes of the Three Questions podcast, including Jennifer's previous episode, and all episodes are now available again on our website. They're also available on Apple and Spotify. So if you want to learn more about the CTA, I encourage you to check it out. Okay, we're discussing the 3 questions buyers and sellers should ask about information collected on real estate transactions. And as you'll see here coming up, there's a cross-border angle to our topic. We have a lot of listeners and watchers in both Canada and the United States, and we don't want to leave my friends back in Canada out of the discussion here, so stay tuned. So these are the questions that a home buyer or seller would ask of Jennifer. So away we go. Question number 1. What kind of information will the Treasury Department and FinCEN be collecting when I sell my property? Jennifer, take it away.
Yes. So people don't always realize how much the government's hands are in real estate transactions. And this isn't new. One of the obligations from a reporting standpoint for an escrow company is taxes, right? So part of any real estate transaction is the issuance of a 1099. And it's a specific 1099 called a 1099-S, which is for the sale of real estate. So on the sale of a piece of real estate, a 1099-S is going to be part of that process on any transaction that's done through an escrow, an attorney, any sort of transaction like that. In addition, when we do have a foreign seller, we're going to be dealing with the government asking for information about that foreigner and whether or not they're a taxpayer to determine if withholding is required. So that's called FERPTA.
That's coming up.
Right? That happens on real estate transactions. And now on the new reporting for FinCEN, if our buyer on the transaction is some sort of entity or a trust, then the government is going to be collecting information relative to that buyer entity and the underlying owners to do reporting and research relative to ownership as well. So there's multiple tentacles of the government in any real estate transaction, trying to collect information and make sure they're getting what they want, which is money, out of our real estate deals.
Yeah, there is always that part of it. There is a cash flow issue or a financial motivation here. Okay,
Correct.
well, thank you for question number one. Okay, question number two, and this one has many layers to it, and we call this the three questions podcast, but in this incident, we are going to maybe have a couple follow-up questions here. So, question number two, I am a Canadian resident. I've
Right.
decided to sell my condo that's located in Boca Raton, Florida.
Mhm.
How much of the sales proceeds can I expect to be withheld, and for how long?
Right. So as I kind of mentioned, the United States has what's called the Foreign Investment in Real Property Tax Act. The issue being that if a seller is not a taxpayer, which means a non-resident alien, um,
Mhm.
the they want to make sure that they get their piece of the pie from a capital gain standpoint.
Right.
So on a sale of a real property, depending upon whether the buyer is going to live in the property or not, which seems like a really odd criteria. I didn't write this. I just explaining it.
Interpret it. You're interpreting it.
If the buyer is going to live in the property that's being sold, so it's residential and the buyer is going to live in it, 10% of the proceeds from the sale will be withheld by the settlement service provider, escrow, and sent to the IRS. If it is not going to be the buyer's principal residence, it's 15%. And if it's over $1 million, it's 15%, no matter whether the buyer is going to live in it or not.
Got
Um,
it.
so depending upon the type of property, and there is a one caveat: if it's under 300,000, it is zero. There's no withholding. But
There's a yeah. Okay. Yeah. That's,
unless you're selling a doghouse, um, you're
or
probably
own a
gonna have
property
withholding.
or owning a property in Ohio,
Correct.
which
You're
I'm
gonna have
familiar with.
your Boca Raton condo is gonna have withholding.
Yeah, you pretty much. Yeah, exactly.
And so
Um,
just I want to explain, withholding is not a tax in and of itself.
right.
All
It's
right.
just making sure that we get paid before you get paid.
Correct. The money gets sent to the IRS. You then, when you file your tax return, will report your sale of the real property. And if you're entitled to some of that money back, if your gain was not more than what was collected in taxes, you will actually get a refund. You'll get the amount of the withholding that is not owed back. But if you don't file, they keep the money. So,
Yeah. Well. Okay. So that leads to my follow-up question, which was, for how long is this money held for? Is there a way of planning for this to say, okay, I'm with being withheld 10%, most likely 15%.
right.
How long is it? Do I have to wait until I'll actually have that money either sent to me in a check or electronically transferred to me, or however they do it? How long is that? What's that timeline
It sits
estimated?
there. It depends is always a very
Of
good
course,
answer. Um, it's based upon the tax year of the sale of the property. So if I sell a property in January
right.
and I don't file tax returns until April of the next year, I'm not going to see that money back until April or May of the next year, right? If I sell a property in December and file my taxes in January, I could have that money back by February.
Interesting.
So it is, but again, it doesn't just come back. It's all based upon the seller's filing of a tax return and the calculation of gain to determine whether there's taxes owed or not owed.
Understood. I get that.
Okay.
But the
But so the
strategy of
timing
selling
is
the property, there's some thought to this. If you know you'd
correct.
want to, if you put a property on the market in June, for example, you
Right.
should try really hard to make sure you close before the end of the year.
Correct. If you close
Otherwise, if
before
you
the
don't
end of the
sell
year,
until January, you're going to be waiting a while before you're
correct.
going to get interesting.
Yes. So, but there are ways to play games with this because it's the government and it's taxes and that's what people do. So, if you really don't have a gain on the sale of a property, maybe you
Mhm.
bought that Boca Raton condo when the market was super high and now the market's down,
Maybe
right?
exactly.
And you took
You're
a
at a
loss
loss,
or
right?
right? You can actually apply for an exemption from the withholding, but you have to apply before you close escrow. So that
Interesting.
application has to go into the IRS before close of escrow. The IRS doesn't move quickly, and so the money will be held in escrow while the IRS thinks about it. Once they decide what to do, a letter will be sent, and assuming the withholding is not owed, then the escrow company will refund you that money
So
that you.
who's the liaison here? Is it Jennifer or the or our friend, for example, Marcine Klein, who I know you know really well?
Correct.
We
So
all love Marcine. So would it be who's going to be who's on the front lines here, prodding the IRS
So
on?
an application, the forms are called, they're 8288 forms, right? So IRS loves numbers, right? So the 8288 exemption form is sent to the IRS. It takes 3 to 4 months for them to review that application. Like they will then send a response that the money is going to be sitting with escrow, right? So escrow will be holding the money, the withholding amount during this time. They'll be the ones who refund the money, assuming you get approval for the withholding exemption. If the exemption is disapproved, then the escrow company will send the money back to the IRS. And sometimes it's somewhere in the middle. We apply for an exemption and they say, no, you get, we want 3% instead of 15% based upon your specific circumstances. All right. So it is a deal by deal. You're going to want to have a CPA or an attorney help you complete the
100%.
forms. Escrow is not going to help you complete those forms.
No,
That's not
no.
their job.
Okay, so this is an IRS requirement, not a Department requirement, correct?
Well, the IRS is part of the Treasury, but yes,
Yeah, yeah, but I mean,
it's that and it's not FinCEN, it's IRS,
God,
but it's
that's what I
still
meant.
under the same umbrella.
Point taken, noted, point noted. Okay, okay. So, I'm so glad we had you here. Okay, so I have one more. This is the longest set question number two, I think, in the history of the Three Questions podcast.
All good.
Okay, follow up.
Yes.
We have a wrinkle here.
Yes.
So the seller of the Canadian resident who is selling their condo in Canada,
Hmm.
pardon me, selling their condo in Boca Raton,
Yes.
their motivation is, and I'm going to just read it to you. If I use the sale proceeds from the purchase from the sale of the house in Boca Raton to purchase another condo in Florida, will I still have to have a portion of the sales proceeds we held? In other words, I'm selling one property, I'm buying another.
Correct.
Am I still subject to that withholding tax?
Uh, yes and no. Again, it depends. So, in a situation where you're trying to perform what's called a 1031 exchange,
Right.
right? So, another IRS tax
Mhm.
code 1031 allows for reinvestment of capital gains, which results in a deferral of tax obligations. It's not a waiver of your capital
It's a
gain,
defer, it's
it's
you're
a
deferring.
deferral. So if your Canadian seller sells that property in Boca Raton and has the money deposited with an exchange accommodator, right? So the idea being that they plan to buy another property and they plan to do a 1031 exchange and the money goes to an accommodator, then the withholding does not happen at that time. All right. All of the money, all of the proceeds will go to the accommodator. If the exchange is successful, right, they buy another property and all of that money gets reinvested into that other property, there's no withholding.
Okay,
However,
okay.
if the exchange fails and they don't successfully acquire the new
Because there's
property,
a time horizon for that between selling of one and buying of the other, a
there
certain
there
amount of
is
time. It's like 45
180
days.
days.
Is it, how many days?
It's it's 180 days.
180, my bad. Okay,
But
180
you
days.
have to, there's a whole bunch of rules. You have to identify the property you want to buy within 45 days,
That's what it is.
and then you have to close within 180
Yeah, so
days.
45 days is right in terms of identifying the property. Okay.
Correct.
All right.
So if that fails, if the exchange does not go through, the accommodator gives you your money back, but they withhold the withholding.
The 10
They
to
have to send
15%.
that money to the IRS.
Okay. So, okay, this is perfect. So there's nothing like going down rabbit holes, and we're going to continue down this rabbit hole, and we're going to eventually hit some bedrock here pretty soon. Okay, so when I think of 1031 exchange, and we both know, for example, James Bean, who has actually appeared on my podcast talking about 1031 exchange.
Yes.
Hello, James. Um, Now, usually people do 1031 exchange, and correct me if I'm wrong, and I'm not embarrassed to admit that I'm wrong frequently. Uh, so most people do 1031 exchange for capital gains purposes. They're trying to defer gains, right?
Correct.
So again, let's just for giggles here, the property in this Boca Raton property, in order for them to be able do they have to have a capital gain in order to be eligible to enter into a 1031 exchange? In other words, if they bought like your scenario where they bought it for say a million one and they sell it for a million,
Right.
can they still utilize that 1031 exchange? Because the reason they'd be doing it would be trying to get around
Yep.
having to have any money withheld, right? Would that be an effective strategy that you'd recommend as an attorney, or would you go back to the escrow people and say, listen, let's try to make a case here that there's no gain required?
Yeah, a 1031 really only makes sense if you have a gain that you're
Okay, I just wanted to make sure of that because you got folks up in Canada are listening to us going, what are they talking about 1031? Okay,
correct.
perfect.
So
All
if
right,
you
I
have a
have
gain
one.
you want to defer, it makes sense. If not,
No
you're really
gains, there
better
has to be
off.
a gain to defer in order for 1031.
Exactly.
In other words, if you get a loss, the best thing to do is try to go to your knees, on your knees to the IRS and say, there's no taxes owing, don't withhold anything, and hopefully they work with you on that. All right.
Again, the timing is all part of this, right? If you're selling in January and you don't want, 15% withheld for a year and a half, file
Right.
for the exemption, right? And hopefully in a few months, you'll be able to have the money. If you're closing in December, you're better off if you have a loss, you take the loss, you offset it with your income, right? Whatever else you have, you can file your tax returns in January and have your money by February.
There you
Right.
go.
So it really is deal by deal, transaction by transaction, situation by situation of how your strategy for dealing with FERPTA.
One of the things we talk about here, and I always encourage my clients to avoid, is trying to be a do-it-yourselfer. If there's ever a situation where do-it-yourselfing is not a good idea, we've just come across it. So on that note, now again, I know you're a U.S. based attorney. Can you assist Canadians, the homeowner, like this scenario, this person in Canada looking to sell the property in Boca? Can you assist people domiciled in Canada on these type of cases? Can you represent them?
Yeah, my clients are owners of real estate in the US. They don't need to be residents
The
or
residency isn't a part of the deal.
correct. I'm not an expert on Canadian real estate.
I wouldn't expect
So
you to be.
you don't want to hire me for that.
No, no, no,
Right.
no. I'm talking about somebody who owns the property in Boca
Right.
Raton or here in Southern California. If they're a Canadian, they could hire you to represent them
Yes.
in a case like we just talked about.
If you need help managing US based real estate, our firm is a great option.
Yes, perfect. Okay, Jennifer Felten joins us. She is an expert real estate attorney, and she's helped me in the past as well, by the way. We're probably going to get into that here in our next question. So question number 3, I plan to buy a residential property and hold it in an LLC. What information is required to be disclosed by me and the co-owners? We're assuming here that the LLC has multiple owners. Jennifer, take it
So
away.
this is the new reporting requirement that we're talking about.
Okay.
The FinCEN has been collecting information on residential real estate transactions when the buyer is an entity since 2016. So the actual what they're doing has been happening for almost 10 years. However, the rule that they were doing under was what's called a geographic targeting order. So as of today, if you buy a piece of real estate, there's a seller too, right? But if the reporting is for the buyer. If you buy a piece of real estate in one of the covered areas, right, the geographic targeting areas, through an entity, an LLC, you and your co-owners, the beneficial owners, right, the same beneficial owners under the Corporate Transparency Act, their information is going to be reported by the title and escrow company to FinCEN. Right now in California, there are 5 counties that are covered under geographic targeting orders: LA, San Diego, San Mateo, Santa Clara, and San Diego. And there's I think 12 states, different geographical areas that are currently covered. So FinCEN has been collecting this information for almost 10 years, and they've successfully enforced against multiple money laundering situations as a result of this reporting. They decided that if it's working, let's see if we can make it work better. They went to Congress and got approval to get rid of the geographic part of that reporting. So whereas right now it's in certain areas, starting December 1st of 2025, anywhere in the United States where the buyer is an entity, it's a residential transaction, and there's no conventional financing, this reporting is going to be required. And again, where the big rubber to the road, the concern for many of us is right now, the reporting is just like an LLC or a corporation. Under the new rule, if you buy in a trust, which many of us, I have a trust, I'm sure you have a trust, right? You're paying cash, you're going to be covered under this reporting rule. So trusts are part of the new reporting starting in December of 2025.
All right. So that just on that happy note. So when I bought a house in Columbus, Ohio back in, good heavens, June of 2024,
Yes.
bought it personally and then moved it into well, the first idea was move it to an LLC, but thanks to somebody who happens to be here on this call, we decided against the LLC and instead put it into our revocable trust.
Right.
Because of the timing of this, I'm not under that new rule, correct?
Correct. Well, 2 things. One, you originally bought it in your name and then moved it into the trust. So it's
Correct.
whoever's the buyer at close of escrow. And 2, the reporting is based upon it goes into effect nationwide December of 2025. So
Right.
any deal done after that date where the criteria of reporting is required, the escrow company will be collecting that information on the owners and sending it to FinCEN.
They'll be doing it. You won't have to. It'll be up to the escrow people to do that, not
They'll be collecting the data from you, right?
Right.
You're going to have to tell them who's who,
right.
but the reporting,
The actual reporting will not be. It'll be submitted by escrow
correct.
or title or whoever, depending on what part of the country you're in. Okay.
The reporting requirement under the rule right now is the title company. So the title companies do it.
Right.
Starting December of 2025, it is the settlement service provider. So for us, it's escrow. On the East Coast, the attorney would be the one who's
Got
the
it.
agent
Okay.
under the new rule.
Okay. Before we put this topic to bed, this has been usually as not interesting. I think it's important that we maybe talk about and be clear about what the penalties are for those who fail to comply.
Right.
I know with the CTA, the Corporate Transparency Act, these penalties are somewhat, graduated. Like an existing business has until the end of this year. Businesses formed as of January 2020, January 1st, 2024, had like 90 days. And I think you maybe know this better than me. Starting next year, they even have less time to report it once they get the business formed. Maybe you can confirm that. I don't know. But what are the penalties on the real estate side? For whatever reason, if you fail or this information has been forwarded to FinCEN, what's the risk here? What's the
Yeah.
penalty?
So let me answer your question on timing for Corporate Transparency Act. Just so
Okay,
that
sure. Why
that
not?
out there. The rule went into effect January 1st of this year, the reporting obligation. So any business that existed before January 1st of 2024 has until December 31st of
Right.
2024 to report. Any business that's been formed this year has 90
90
days
days.
from formation to report.
Right.
The actual rule is 30 days, not 90 days, but they gave a 90 days for the first year for people
Okay,
to
so I
get
had
used to
it
it
right.
and
There you
comfortable
go.
with it. So any business formed after January 1st of
There's
2025 will
30
have 30
days.
days
Okay,
to
so
do the reporting.
Oh, I batted,
Once
I
you've
batted
done
1,000 on that one.
once you've done the reporting, there's no it's not like California, which has a statement of information for an entity that has to be filed every year or two, depending upon what you own. The obligation once you've reported is to notify them of any change.
Right.
So if an owner changes, an address changes,
Address.
any sort of triggering event, then you have 30 days to notify them of those changes. Okay. So that's
Okay.
Corporate Transparency Act. Under the FinCEN real estate rule, the reporting agent is the escrow company. So if it's not reported, they're the ones subject to fines and
Interesting.
not the consumer. However, this is an affidavit. This is under penalty of perjury. So if you do not provide accurate information, it's a crime. It is a federal crime, and you could be subject to criminal penalties for fraud.
All right. So the disclosure between the disclosure you provide or the individual provides has to be accurate.
Correct. And you want to make sure that what you give to your escrow company on your real estate transaction is the same thing you reported under the Corporate Transparency Act.
Right.
Because the same people are looking at that data.
Yeah,
so
they're going to like, wait a minute.
right, exactly. So I know I'm hearing a lot of people's CPAs are doing the Corporate Transparency Act reporting for them. So they may not even know what the CPA submitted. And then they go and do the reporting under a real estate transaction. There might be a discrepancy. So super important that you want to make sure that whatever you reported on the BIOR for the Corporate Transparency Act through the portal matches what you tell the escrow company relative to your entity.
Very good. Well, Jennifer, we have listeners across the United States and Canada.
Mm-hmm.
So for those watching on our website, we've included your information for all to see. However, for those listening, could you share with us what is the best way for them to contact you? Because I am sure that we've opened up quite the Pandora's box here. So how is the best way to contact Jennifer Felten here in beautiful Westlake Village, California?
Right. So my email is jennifer@relawapc.com. That's our company, RELAW. And then APC stands for A Professional Corporation. So our website is relawapc.com. You can reach me at jennifer@relawapc.com. I'm on social media. I'm on Facebook and Instagram and LinkedIn and TikTok, whatever, YouTube. All under Jennifer Felten, ESQ for Esquire. So you can find me on any social channel. We put out lots of content trying to help educate and get people up to speed on what they need to know about their real estate transactions.
And I'm sure once we post this, it'll be shared across all those channels as well. So yeehaw to that. Jennifer, thank you so much. What a lot of fun. I'm really glad we had you back. You provide a lot of clarity and guidance here, and I'm sure the audience here is feeling far more informed, and at least they know well enough. Again, like a lot of things here in the U.S., this is not do-it-yourself stuff. You want to bring in a professional like yourself. So thank you so much for joining us today. Jennifer Felten is the principal with Westlake Village, California-based RELAW APC. Jennifer, thank you very much.
Thanks for having me, Wayne. This is great.
I look forward to bringing you the 3 Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube and podcast channels. And to receive notification when our latest episode has been posted, please click on the notifications bell. And last but not least, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.